Welcome to Intelligent Investor Insights with Joshua and Robert Barone. They're your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Joshua Barone here, back behind the mic in Reno, Tahoe, where Dad looked at my GDP forecast and asked if I'd accidentally swapped it with the CBO's Christmas list, the Congressional Budget Office. Today, we're tearing into a question I keep getting from clients, folks at conferences, even at backyard barbecues. Does all this new crypto regulation threaten Bitcoin's decentralization? I get it. The headlines make it sound like every vote in Congress somehow changes the Bitcoin protocol. But let's set the record straight right out of the gate. FIT21, all this noise coming out of DC, none of it actually changes the backbone of Bitcoin itself. The protocol doesn't care about Capitol Hill. Its consensus mechanism, globally distributed nodes, permissionless miners, cryptographic proof, none of that is up for debate in a Senate subcommittee. As Bob Barone often puts it, no regulator can rewrite the Bitcoin ledger. Let's not pretend the Fed can issue a protocol patch. He's right. The CFTC's been crystal clear. Their authority stops at the trading venues and derivatives markets. Same goes for the Fed. They're saying out loud, changes to Bitcoin, protocol changes, only happen through network-level agreement. You can't legislate block production. I keep thinking about a line I wrote way back when. The machinery behind the market may be more valuable than debating Bitcoin's final destination. The guts of this thing, the code, the consensus, it doesn't bow to US law or European law. It's global, stateless, and no one has privileged access, unless you count Satoshi, the pseudonymous creator of Bitcoin, who, refuses to return my calls. And look, sometimes I'll mess this up and say the wrong year or mix up the layers, but the big picture is this. Legislation just can't reach that deep into the protocol. You can regulate access points, but the network keeps humming along regardless. But, and there's always a but, right? Let's talk about where the rubber really meets the road for most investors. What's changing isn't the protocol, it's everything layered on top. The bridges and toll booths built to let you or your clients get Bitcoin into a portfolio. FIT21, for example, requires exchanges and custodians to register to comply with capital and custodial requirements. Translation: suddenly you need a big balance sheet and legal muscle to participate. Who's best equipped for that? Not the two-person exchange running out of a garage. It's the big, institutionally backed intermediaries. This isn't just me spitballing, it's straight out of the Bank for International Settlements playbook. Blockchains are decentralized, but the economic activity around them, that's funneled right into the hands of huge firms, ETF sponsors, regulated custodians, the household names. Let's be honest. If you're buying Bitcoin through an ETF or a trusted app, how decentralized are you, really? Bob always likes to needle me with a question, and he's got a point. I looked at the filings, ran the numbers. What we see is a handful of ETF sponsors and giant custodians holding piles of the actual Bitcoin. It's not some grassroots, peer-to-peer financial revolution. Honestly, it's starting to look a lot like traditional finance. If you're listening to this thinking, I trust my ETF provider and I don't want to manage cold storage, that's valid. But you've got to be clear-eyed. The protocol might be decentralized, but most access points are anything but. The access to Bitcoin is centralizing, no matter how much the underlying blockchain isn't. Dad would say, don't conflate the plumbing with the water. Terrible analogy maybe, but it's kind of true. Now, here's where things get even squishier. Most of the inflows into Bitcoin today, at least if you're looking at the institutional data, aren't even touching the blockchain itself. They're plowing into cash-settled futures, ETFs, synthetic products, all the off-chain vehicles that don't involve actual Bitcoin changing hands on-chain. Pull up the CME docs. Their Bitcoin futures are all cash-settled, no physical delivery. Same thing the IMF's hammering home. Most institutional crypto exposure now happens through off-chain products. It's like a wall's been built between the network and the markets. A client called me the other day, a smart guy, and said, "Hey, I own Bitcoin in this ETF, so I'm good, right?" And I had to break it to him. What you own is basically an IOU. You don't have your keys, you're nowhere near the blockchain, you have exposure to price, and that's about it. Dad once joked, owning ETF Bitcoin is like having a deed to a house in Monopoly. He's not wrong. Try to claim the actual house and see how far you get. There's this swelling disconnect now. Market prices and activity are increasingly driven by these derivatives, never touching the real on-chain asset. It's leverage layered on leverage, and custodians sitting on the real stuff while everyone else shuffles paper around. So to wrap all this up, at least for today, Bitcoin itself, still decentralized, still humming away, still stateless. But the economic rails being built around it, the ways you access or own Bitcoin in 2025, they're starting to look suspiciously like the old world of finance. Centralized, regulated, and if we're really honest, disconnected from the core technology. I think that's the structural story that's going to define the next decade, not whether some senator can write code to change the protocol. Structure is the story. That's it from me. If you've got thoughts or you think I mixed up another analogy, drop me a line. We'll pick up the thread again next episode.